Maybe you are tired of listening to all these crazy theories on how you should manage your portfolio, and you're looking for the five top principles taken from Nobel Prizes of how you should manage your portfolio. So in this video, we are going to share with you these five principles on how you can manage your portfolio by yourself. So the first principle of a portfolio should be that risk and return are interconnected. They act together. If you're asking for more return, you should run more risk. Let's see with this with a practical example. As we say, this is just for education only. I'm not suggesting any particular investment here. We are just running some numbers here for you to see how this looks in real life. So we have two different portfolios here that we can say that these portfolios are like cars that go at different speed. You see this one is going at 88, this one is going at 42. We can definitely say that a portfolio that is going faster, you can ask for more return because you're experiencing more risk in these kind of portfolios. But what we see here, if we add these two portfolios together, of course your global risk comes down. But let's just see one particular portfolio to see how it behaves in a different way. Let's go for the riskier portfolio here. Let's mute this one and let's just see as you can see, it has Bitcoins, different kind of assets, like index funds and things like that. As you can see, this portfolio is going at a higher risk. What it means is like you can experience some turbulence. Your balance can go up and down. As you can see, the gap between these two values is wider here. Well, actually, the return that you're going to ask for these kind of portfolios is also bigger. And also, we're going to see that, in this case, as you're asking for more return, you're experiencing more risk. And it maybe has no bonds, maybe have some cash, and maybe have some crypto assets or other kind of assets, depending on your risk profile, of course. Always consult your financial planner for this or an advisor. So if we go to see the other one, and we see the other one that is going at a lower speed here, let's mute this one, we will see that now the percentage range is almost half the one we had before. And what else we can see? Well, of course, the return is going to be lower, and the different assets that you're going to have in your portfolio will be like 50% bonds, and here more stocks here. When you see it, this is the way that your portfolio should be built. Is if you're having more risk because you want more return, this is the way it should be done. But what we have seen in some of our hourly clients is that sometimes they're running a higher risk, but they are not getting a higher return here. So really important, always take into consideration when you're adding some assets to your portfolio, what is the risk against the return. The second fundamental principle here is diversification, reduce your risk. Sometimes I talk to my hourly clients and they say, well, I'm really diversified. And when I see their portfolio, they say, look here, I have 5 different kind of crypto assets in my portfolio. And then I will say, well, that's not diversification. You're concentrating your assets in one particular kind of assets there, but whatever happens to the crypto is going to affect all your cryptos, maybe in a way. Maybe you're saying, no, this is going just to affect one of them and not all of them, but it's not going to be the same as you have an ETF fund or index funds. This is not an investment suggestion, but we can see it here. It's like if you have an index fund and you has invested in technology, financial services, everything at the same time. When you buy this kind of ETF, we can say that maybe something is happening in technology. Maybe the market is feeling that technology has grown enough, or that maybe it has more room to grow, but maybe something is happening to it, but maybe not to the financial services sector. So when you have a diversified portfolio, what you're looking for is like, well, I want to have some bonds and some stocks. Well, for why I want to have some bonds? Well, maybe you're getting some good rate of return there, some yield there, but also you want to have it so you can be able to rebalance your portfolio. Maybe when your stocks are coming down, maybe your bonds are coming up, and you want to rebalance that because they are not they don't have the same correlation. They don't move in the same way. Because if you only have, like what I was mentioning, I don't know, you buy Coca-Cola and Pepsi, then if both of them, all the soda industry is going down, your whole portfolio is going down and you don't have anything that is holding you there. I know this sounds like, well, something really easy, but when we see our clients' portfolios, hourly client portfolios, we can see that sometimes they really believe that they are diversified. But when we gather all the information, we can see that maybe you have some big concentration in just a few kind of stocks. Be careful with that, and remember, diversification reduces your risk. The third principle for your portfolio. We were talking about Harry Markowitz and how he earned the Nobel Prize for this research that I'm going to show you here. So when we have been saying that for you to be a rational investor, I will say that, oh, well, you will always try to look for something that is going to give you, a higher return for for a particular risk. You're not going to try to say, oh, if I have two choices, I will go for the one that is going to give me the same return, but one with more risk than the other one. Let me show how this theory works in practice here. We can say that here we have all the risk. It's like if your portfolio is getting riskier, it will go to this side. And here we can have the return of your portfolio. And let's just focus here and we can say, well, this one, this is your average portfolio. And if it goes a little bit here, we can say that the pieces that you're putting inside your portfolio are adding more risk. And let's see if that risk was worth it or not. So if we see it here, well, like we can say like this is almost in 16 of your risk. It's the standard deviation there. But we can say here that, well, the return that you were getting here is a minus something. Instead of the return that you're getting here is like 9%. So if I have to decide which one of these two assets I would like to have in my portfolio, I will definitely say that I would like to have one that will give me a higher return for the same amount of risk that we are running there. So it is always really important when you're adding assets to your portfolio to double check if that asset is going to give you the return that you want for a set risk that you're maybe thinking with these kind of numbers. The next principle is you have to be tax efficient. Let's say it this way. You have a taxable account where you're paying taxes on your dividends, on your capital gains, or maybe on the interest that some bonds are producing for you. Remember, capital gains is just you bought a stock or whatever, an ETF or an index fund, you bought it for 100, and now the new value is 130. Those 30 will be your capital gain, where you're gonna have to pay taxes when you sell those assets. But then you can also have the chance, I don't know if you have a 401k in your company, or you can contribute to an IRA account, or maybe to a health saving account, or just a flexible pending account, or any other of accounts like a 403b or 457. But you have many different buckets where you can be contributing for your investments. But in these particular buckets, I'm not saying when you're going to pay taxes, but what I'm saying is like in these particular buckets, your money can be growing tax deferred, or maybe it's a Roth account, you already pay taxes on the money that you're contributing, so you're not going to pay taxes with some conditions there. But if we see it in this way, if you have two different you're building your portfolio, and you say, where I should put the assets that I believe are going to grow the most, I will definitely say that those assets should be going to your tax deferred or your taxable, the accounts that have some tax benefits for the future. Because if these assets are going to grow faster, you want to have that benefit there of not having Uncle Sam taking one part of your assets when they are growing. Instead of the other portfolio that maybe you have a taxable account, there you want to have those assets that are going to grow because you want your money to grow, but maybe they are not going to grow as fast as they will grow in the other portfolio that you're building. So you also have to be tax efficient when you're building your portfolios and take this principle into consideration. And another principle here, as an investor, you should behave rational, and also you should be risk averse. What it means is sometimes I see with my hourly clients that they fall in love with a particular stock or with a particular company, and no matter what the actual numbers say that is happening with that company, they don't want to sell it. They just fall in love with the company. They are not being rational. They are not looking at the numbers. Sometimes they bought that company long time ago, the situation is completely different. Now it's like they're still like betting to that company and not taking into consideration what is really happening with that company. When you have an investment, you have to be rational to leave. I mean, leave a little bit your feelings a little bit to the side to take rational decisions. For example, if you have in your portfolio a stock that you know that it went really, I mean, that price is I don't know, at the floor because it went really down, but then you decide that I'm not going to sell it because I'm hoping that the stock will go up. That is like an act of faith, but it's not behaving like an investor. You should say like, is this company, or is it really has the potential, I mean, to grow in value again? Because if not, you should sell that company. I mean, harvest that loss that you're having there for tax reason also, and then invest in a different company or different investment that you're thinking there that could have the potential to take you where you want to be. So remember always to be a rational investor. And we're gonna give you an extra information here, just like a real bonus here. When you are reviewing your portfolio, it's really important to review how much are they charging you for your, I mean, for your investment products, for your mutual funds, your ETF. Yes, investment products, they have a cost and you should know how much they're charging you. I'm not talking here about how much you're paying to your financial advisor because you're managing your portfolio by yourself. I'm talking here that all the investment products, they have a cost, they have a fee. You are paying something for that. So in this particular example that we were drawing here, we can say like, well, this portfolio is going at a high speed. Well, it has this, I mean, this deviation, and it's looking for a good return here. But you can see here that the expense ratio that you're paying, this is not the advisor fee. I mean, the ratio, I mean, the expense that you're paying for the mutual funds or the different kind of investments that you're having here, we can say that is really high. And here what is going on is that your return is like your net return is coming down, because if you are able to reduce your expense ratio, well, your net result will be even bigger. We hope this information has been helpful for you as a do-it-yourself investor, but if in the future you feel that you need a second opinion or just a validation of your portfolio, at Advice Financial we provide hourly financial planning so we can help you to validate your portfolio or just to review if you're in the right track. Thank you.